Good afternoon, everybody, and welcome to Gamma's GeoInsurance webinar, where we're going to explore new risks and measures for understanding the impact of climate change on property. My name is Richard Garry, and I'm the Chief Commercial Officer at Gamma Location Intelligence. First off, thanks for taking the time to join us today. I know everyone's busy, so what we're going to do is probably aim to wrap up in about 50-55 minutes and hopefully give you time to get a cup of tea before your next meeting. Just some housekeeping. There's a button down the bottom right of your screen, questions. If you click into that, you can type in any questions that you've got. What we'll do then is try to answer those questions maybe in line as we go through, or if you've got time, we leave until the end. Hopefully most of you already know a little bit about Gamma and are familiar with what we do, but for those that don't, what I'll do is I'll give you a sort of a very quick overview. So Gamma is a cloud-hosted solution provider that integrates software, data and services to help our clients reduce risk through the use of location intelligence. So what does this mean in practice? It's effectively what we do is we provide solutions to the insurance and actually to other sectors as well, like the financial sector, that include the likes of geocoding, peril data like flood, subsidence and crime, and also building attribute data from our AddressLink product. So accurately positioning risk locations and then seeing what perils affect or what information is available for that place. So a location could be an address or a postcode, it could be longitude, latitudes, or a building or a field. And then what we can do is tell you what's happening in or around that location, always with the aim of supporting better decision making. Gamma LI have been around for 29 years, but a particular focus really is the insurance sector for us for the last 10 to 15. This experience allows us to bring our knowledge of location and risk to bear on the climate change question, which we're here to talk about today. So we can do is project what's likely to happen in the future using different scenarios and time horizons. All our data is accessible through web services and can also be visualized within our geo-underwriting web mapping tool, Peril Finder. So back to what we're here to talk about today. For the past few years, we've run a series of GeoInsurance webinars with the aim of keeping the insurance sector and other sectors more recently up to date on developments with regards to property risk, with a special focus on data and what's happening with ESG and climate change. And we're continuing this today with a review of data that can help with property level assessment of climate change impact. We look at the regulatory landscape and also how flood and emissions data can be measured and reported on to help with regulatory submissions. The webinar explores some of the challenges and practical approaches taken to track and report on risks and the impact on property class assets. Our first speaker today is Michael Keating. He's the CEO with the Managing General Agents Association, the MGAA. Mike's he's got over 40 years experience in the industry, including time with everybody from insurers, brokers and MGAs in both commercial and personal lines markets. He's held executive positions at AXA, Midas, UK General, and more recently with an insured tech startup, Claims, before becoming CEO at the MGAA in September 2020. Now, despite being a Manchester United fan, which we won't hold against him here, we're delighted that he can join us to provide a review of the current position of MGAs and how they're looking at climate change impact. So, Mike, I'll hand over now to you.
Richard, thank you very much for that fantastic sort of introduction. And clearly, I don't look at all like I've been in the industry for 40 years. You know, I started off at 6'3" and I'm now 5'3". So there we are. So good afternoon, everybody. What I'd like to do really is just set the scene in terms of, you know, the MGAA, talking to our respective members on where they are around ESG and data and then look forward to Feargal and Jason doing their piece after me. So I suppose the first line I would say is that capturing data will become mandatory. There is absolutely no doubt about that sort of going forward. And we have over 50 insurers as members of the MGAA. And what I can share is that nearly all of them, although they're at different points in the journey, are already discussing with MGAs and their distribution partners areas around capturing ESG. Some, certainly those insurers who've been very public around net zero targets, I would say are ahead of the curve in terms of their sort of journey, in terms of data, what data to collect, how they can collect it. But certainly the others from our membership, are not too far behind. And they're clearly coming back to collection of data, and no doubt in the audience today, people are still particularly scarred around the fair value attestation and the data which had to be collected through the distribution chain for product value. There's no doubt, as I said at the start, that there will be a further request for ESG as we move over the next sort of 12 months, 5 years from that perspective. That is absolutely key. And then that will also put challenges and opportunities into the distribution chain, because if the insurers are asking for data from MGAs, which they will, then certainly those MGAs who deal with brokers will need to engage with their brokers and then look to get that data from the brokers and then ultimately the client. So, this is not going away at all. I think it's going to be ramped up over the next sort of 12 to 18 months, without doubt. There's questions around how that data should be collated, which no doubt will be picked up later, the question around standardization or not standardization. But again, let's be clear, it will put further pressure into the sort of value chain in terms of collecting this particular data. The other area, I think, which is really important, and again, feedback in terms of setting the scene from our membership, is that, with the sort of flight path of insurers towards net zero and capturing this data, there will no doubt be consequences, which probably haven't sort of revealed themselves yet. And those consequences will be, in no particular order, a potential change in risk appetite for insurers, number one. Number two, the withdrawal of from some sectors, effectively, less choice in terms of the market. ESG pricing will become more of a factor. What that looks like today, what that looks like going forward. Again, who knows? That's a first mover opportunity potentially from there. And then clearly the supply chain profile, which obviously in the motor market, has already sort of picked up in terms of sort of green parts, which we're all aware of. But, becoming ESG compliant in the supply chain will become, again, very, very important to insurers who are deploying capital to MGAs. So again, it's something which, is on the horizon, but is here now, and actually will become more and more important as we move forward over the next sort of few years. What I am encouraged about, however, is that, and again, talking to insurers and talking to Lloyds, is that they see this as a transitional period, which I think is really important, that they're working with, their MGA partners and actually trying to make sure that the transition is smooth for everybody in the value chain, as opposed to sort of, dropping it on people and saying, right, you now must conform to this. So providing that collaboration, that exchange of views, the interaction between everyone in the value chain remains healthy and constant, and we as an association will look to be quite right at the heart of that, then I think, the industry will come through it and the segment, very healthily as we go through in that particular period. If that communication, collaboration, becomes cloudy, then I think, we're going to have some real challenges. So effectively, our message as an association to all stakeholders is, remember, it's a transitional period. Remember that everyone's on the journey, but expecting to achieve the same sort of common goals. But make sure that communication is timely and regular and takes account of everyone in the value chain. Thank you, Richard.
That's great. Thanks for that, Mike. Glad to hear you were talking there about ESG in terms of pricing and a potential opportunity. It's good to see that there are other uses for this type of data beyond the regulatory pure this is a stick. I think there's definitely some opportunities there for somebody to start moving in this space. Okay, thanks a million for that. So our next speaker is Feargal O'Neill. He's the CEO with Gamma LI. He's going to tell us how climate risk can be measured and the impacts on property. Feargal's a pioneer in location intelligence, as well as leading Gamma since 1998. He has co-founded several other technology companies, including Autodress, who are a geocoding API company, and another venture called BEOR, which is a building retrofit technology company, both in the location intelligence and data spaces. I now hand you over to Feargal, who will tell us a little bit more. Feargal, you're muted there.
Sorry, can you hear me now?
Yeah.
Okay, super. Okay, so thanks, Richard. I'm going to look at property risk impacts of climate change and how it's been measured by the insurance industry. So the first obvious statement is, surprise, surprise, climate change is increasing the risk for property. And indeed, it's making it less predictable as a process. To make matters worse, and in a sort of a risk spiral, property is also increasing the risk of climate change through the emissions that they produce. So as a result, any large organization with property assets, mortgage books, or indeed insurance portfolios, they need to effectively assess both risks. And the two risks are called physical risks, which are the risks associated with increased perils and affecting the property physically, and transition risks, which are risks associated with moving into a low carbon economy from emissions and in climate change. So the easier one that we can talk about, first of all, for insurers is physical risk. And physical risk is an easier one in that insurers have existing models and systems already employed to assess the physical risk of perils on property. The big issue is that it's changing and the models are changing. So when we talk about physical risk for property, first of all, in insurance portfolios, we're effectively talking about more frequent, more intense, but less predictable peril events, such as flooding, storms, droughts, subsidence, wildfires also come into this part of the world, which probably wouldn't have been an issue before. They're not, outside of the increases in terms of claims, they're not a huge issue if they're priced correctly. So the real issue here is that can these be priced correctly so that they don't lead to increased loss ratios. On the investment mortgage portfolio side of property, when we're talking about physical risks for property, we're really talking about loss in value of investments due to this increased physical risks as properties find themselves falling in zones that are within increased risk areas due to climate change, or indeed, in terms of mortgage providers, the ultimate situation where there's increased mortgage defaults due to properties being affected. The real challenge to insurers really is in looking at the existing models and changing them to take into account of this new climate change scenario. Traditionally, in terms of physical risk models, we're looking at stochastic models, which are very backward looking. They're looking at historic data. So in the graph we're looking at here, you can see the pattern in terms of temperature change from the 1950s to the current day. It was varying around a sort of mean. It was reasonably stable. In terms of where it goes by the end of the century, there's a number of different RCP scenarios being predicted. So the existing models really aren't fit for purpose. And so what we're finding across the globe is a lot of work going into new different methods for predicting physical risk, coming from other techniques such as machine learning, which are taking over some of the more traditional models. And if this is brought in, it certainly reduces that risk. Transition risk is a different kettle of fish for the insurer, in that it's something that we haven't been familiar with using in the past or assessing. It's effectively the risk for moving to a lower carbon economy. It's trickier. It's only going to get more complicated. So how does that manifest within the property asset class and property risk? So what we're really talking about is high emissions, inefficient properties, and the risk they have on the insurer as society expects net zero targets and emissions to be lowered and climate impact to be lowered. So one of the big risks in that respect, in terms of investment or mortgage portfolios, is the risk that it reflects badly on the business reputation of the property owners or the property underwriters. So reflecting badly means that stakeholders, investors, customers, employees consider less of the company and act accordingly. These emissions count in scope 3 emissions, so they're generally disclosed. So it doesn't look good effectively for an insurer or bank to actually not be making progress on reducing the emissions of properties that it has under its control. On the insurance portfolio side, it's something similar in that it can reflect badly on business. The other aspect to both types of property portfolio as well is they lose value. In the future, properties with low performance in terms of emissions are going to be worth less. They may require additional work to be carried out in them to make them compatible, and indeed they may also be open to fines for the actual owners and for the managers. So in terms of these types of risks, what actually are insurers trying to measure in each case? For physical risk, it's typically the total value at risk that's been trying to be measured. And also insurers are regularly tracking losses versus expected losses. They're doing that effectively to see if the current models are predicting correctly, and as the climate changes under the different RCP scenarios. For mortgage providers, they're typically really just looking for a count or an aggregate asset value within high risk zones. So a little bit of a less sophisticated view is required in that case. For transition risk, typically the measure that's been disclosed and carried out is greenhouse gas emissions from the property portfolios. That's generally reflected as either total carbon, absolute carbon emissions, or indeed as carbon intensity metrics. So one of the problems globally in this is defining what is the standard and what should everyone be doing in terms of measuring these emissions and reporting on them. And there's been numerous organizations, task force, partnerships. They all tend to have a four-letter acronym associated with them for some reason. But probably the most notable of all of these is the TCFD, which really represents the Bible in this area. But the regulators such as Bank of England would have also produced a lot of information, the UN, the EU. Probably the most practical of all of these, if you're looking for a document to read, is I would suggest the PCAF or the PCAF is produced a document called the Standard, first of all, for financial institutions, for banks. And then recently they have formed a partnership with the Net Zero Insurance Alliance to set up a working group. And they only in the last couple of weeks have produced a document called the PCAF, Global Greenhouse Gas Accounting and Reporting Standard for Insurance Associated Emissions. It's a long title, but well worth a read. And it's very practical in terms of identifying methodologies and metrics that can be applied straight away in terms of making disclosures or calculating emissions for your property asset classes. Let's look at a couple of the PCAF metrics and how they basically say we should go about recording, measuring emissions. So the first one we look at is in terms of insurance associated emissions. There's two parts to it. It's effectively looking, first of all, calculating the emissions themselves, and then applying what's called an attribution factor to it. And the attribution factor is effectively the amount of those emissions that should be associated with the insurer. So how much they're responsible for. And they've given a couple of areas in terms of guidance of how that attribution factor can be produced, but it's largely left open to the individual insurance company to decide themselves. If we take an example from the Aviva Climate Transition Plan 21, they came up with a suggested underwriting attribution factor for property, which I think is plausible and certain very practical, where they look at dividing the technical premium by the annualized asset value, which is something like the rental value. So by working out that ratio, multiplying it by the emissions, you get a calculation for the insured emissions from that property asset class. The other area that has to be decided in terms of how one discloses emission data is the type of emissions figure that is going to be produced. Absolute emissions is obviously the most straightforward, which is just the total of all the emissions for the aggregate properties within the class. But there's others as well. There's other emissions intensity metrics, such as the economic emissions intensity, which is those emissions as a ratio of gross written premiums. So again, in many of the disclosure reports, you'll see several used. The final requirement, I suppose, general requirement that the PCAF suggests in terms of reporting and scoring emissions is to come up with a data quality score. So, and to report that along with the emissions data. So in this, it goes from the highest score down to the lowest, score 1 being the highest, score 5 being the lowest. Score 1, for example, in emissions data may be the actual emissions recorded from each individual property on site, down to the lowest, which would be a modeled estimate based on averages for the country, for example. So there's two aspects to that. One is in actually reporting on it, but secondly, for the data owner, they can see as well in terms of the quality score, where it has a high proportion of asset classes or subclasses that are corresponding to high levels of emissions, but have a low data quality score. So it gives them focus to see that, well, if we really focused on that group of data that's got a data quality score but is yielding very high in terms of our greenhouse gas emissions, we might be able to reduce that by getting better quality data. So it shows where improvements can be made across the asset class and calculations. So next, let's just look at how we measure the emissions themselves. And again, the PCAF is good in this, in suggesting ways that these emissions can be calculated. So the first one to look at is in domestic property. So in domestic property, generally, the most widely used source is EPC data. So EPC surveys are carried out across hundreds of thousands, millions of properties across the UK. That data is available to a certain extent and can be used to, again, estimate the emissions coming at both domestic and commercial level. Where the data doesn't exist for individual properties, it can be modeled based on property attribute information, based on property typologies, so that you can get a more comprehensive view across the portfolio. It should, again, of course, be scored based on the quality. So this would probably, if it's using model data, would be lower down in the score rating. And again, it has to be weighted to work out what proportion of those emissions should be included for the insurer. Commercial property is much more complicated. Where EPCs exist, it's fine, but remember, EPCs only relate to the actual building fabric itself, not to the activities going on inside. So if you had a building with an iron smelter in the middle of it, it's not recording the iron smelter's greenhouse gas, just the actual lighting, heating, water heating, and so on of the building. It's much more difficult to model because there's far more typologies of commercial premises than there would be for residential premises. So instead of often looking at the actual property itself, some alternatives for commercial property assessment would be looking at the NACE code. So what do that particular sector get on average in terms of emission intensities? There's rating agencies such as S&P who will have emissions data for the larger companies that you can download and match up to the companies. In terms of what is considered compliant as regards emissions, the EU taxonomy has come up with a wide variety of information on this. And just a highlighted point here is that at present for buildings built before the 31st December 2020, an EPC class A is considered compliant, or if the building is within the top 15% of the national primary energy demand performance levels. For buildings built after 2020, it's a much more onerous, detailed requirement with requirements from everything from pollutions, ecosystems, and so on. So there's a lot of information required. I suppose the key thing to take from this is it's going to get more complicated and more onerous in terms of capturing this information and reporting it. To see this in action, I'd strongly recommend looking at any of the CRFD reports, the climate-related financial disclosure reports that are produced by the insurers, by the banks. Here we have Aviva's, a couple of tables from the Aviva report, and indeed Nationwide's in the middle. So in that, you'll see how the PCAF and some of these other standard methodologies have been applied in terms of the total carbon emissions, in terms of, on the left, tracking losses versus expected losses. So you get a good idea how these various asset classes are being reported and how these methodologies are being applied in practice. There's a lot of challenges associated with this type of reporting. Obviously, as we've seen, there's a huge lack of data. There is also conflicts with GDPR. There's always an issue of privacy with some of this data. There's legislation going through in various countries to try and make property level energy emissions data more accessible, make it less defined as personal data. There's a case going on in Denmark, for example, at present that will hopefully open up this data a bit more, because without the actual EPC data available, it makes it very difficult to do these calculations. The EPC data itself is only based on average usages of buildings associated with the main functions within the building. So there's a lot of assumptions behind it. So again, we can hopefully improve on that in the future. It's not standardized across countries. Even in between the UK and Ireland, there's different approaches to EPC ratings and measurements. In terms of physical risk, as I've said earlier, there's a requirement for updating our historic stochastic physical risk models and bringing them more into the new requirements where the climate isn't quite as stable as it used to be. So it is a huge task. We're also looking at only at the start requirements for the EU taxonomy information. So that's going to get much more complicated and have a much greater set of requirements. So finally, before I finish, just one other aspect is what I suppose the examples we've given here are very much for larger insurers, financial institutions and banks. What about smaller insurers, MGAs? What are they to do? Although it's not mandated yet, there is certainly regulators are starting to expand the scope. Capacity providers need this information. They need to disclose it. So I would suggest that by having your property data coded with this sort of information, risk emission values, might be an advantage. You are part of your client's scope 3 calculations. So it may be an advantage to have some of this information pre-prepared before they come asking for it. It's going to get more complicated as we go on, in terms of we're only really looking at climate change, adaptation and mitigation at present. When we bring in other aspects such as biodiversity and pollution, the requirements may indeed increase. There is a useful document that was produced by Lloyd's in 2021. Their guidance for MGAs in terms of ESG. So I'd certainly recommend a look at that. In it, for example, they suggest that a risk management system looking at the financial risk of climate change in line with the PRA supervisory statement would be a requirement or a recommendation. So there's a lot in that to sort of point you in the right direction. Okay, that's all from me. I'm going to pass you over to Jason, or to break back to Richard, actually. Thank you.
That's great. Thanks, Feargal, for that. Good to see that there's quite a lot happening in that space. There's a lot of documentation there that you've referenced. What we'll probably do after this is share some of those links to the various reports, the PCAF and the TCFD, etc. We do that as a follow-up piece. One question, actually, Feargal, just in relation to accuracy. If we can't accurately measure emissions, should we wait until there's better data available?
So the short answer is no, in that, there's a general acceptance globally amongst all these groups that have gone out to set standards, and also with the regulators, that there is a huge lack of data, particularly in this area of emissions. And the general guidance is use the best available data that you have at your disposal and build on it over time. That's certainly a better approach than not doing any disclosure at all. So I would say, even with the issues that are with the data that we have, having that and building on it over time is a much better solution.
Okay, that makes sense. So our next speaker is Jason Day. He is Head of Location Intelligence with Gamma. Jason has almost 30 years experience working in data and analytics businesses, helping to solve insight challenges for organizations across a variety of sectors, with a particular focus on the efficient use of data to help shine a light on the answers to business questions and to aid in making informed decisions. Today, Jason is going to talk us through a new template for climate change property risk reporting. Jason.
Thanks, Richard. Crikey, data doesn't lie. 28 years, I can't believe it. I need a recount, I think, on that. Hopefully everyone can see the screen. Climate change property risk reporting. So thanks to Feargal and to Mike for giving us the view from the high level in terms of what's expected from an industry perspective, but also the sorts of undertakings that are required in order to pull this type of detail together for those that require it. Certainly there's seemingly a lack of data versus the need to do something. So you guys are probably feeling the pain of that massively, being caught somewhat in the middle. In short, I guess it's hard, it's painful, and possibly it's not a surprise that many are taking a stance of, well, let's wait and see before we make an initial step. It's always easier to do something else. We get it. We're a business too. There are plenty of other pressures to be contending with. Of course, we wouldn't be here today if we were advocating that approach. So do nothing is not a suggestion, but do something. Make a start. That's certainly the perceived wisdom that we tend to hear as we talk to people in the marketplace. And whilst I'm not necessarily here to say that we have a silver bullet for you, we're certainly here to help you on your journey and evolve that solution, whatever that solution may look like, as things and requirements change over time. So, what is it we can offer? Well, essentially, it's a report, and I almost feel like I'm taking a retro step backwards by saying it's a static report. Given that things are changing, the suggestion of buying into a massive system in order to solve your problem, or from an initial reporting perspective, probably doesn't make sense in the first instance. But making that start, you need to start somewhere, and therefore perhaps a static report is a good place to do that. That report would highlight the current and future impact of climate change on your existing book of business. It would be property centric, and it would deliver insights relating to climate value at risk. What is the current and future impact on your book by peril? So in terms of those physical risk measures, and in terms of emissions, be that carbon footprint. So understanding the scope 3 insured emissions and the challenge that you face towards achieving net zero. So those transition risk measures. Clearly it would be fact-based, but also there is that potential in working together collaboratively to provide some context around the plans and strategies that you have for the future. And as an independent review of your book, it could also be used as a means of communication both to internal and external stakeholders. And then finally, almost as a byproduct of what we would be doing, there's the potential to enrich any existing data that you may have. It's not something we're expecting clients to commit to, but it's certainly something that we can potentially provide. But what does that actually look like? Well, in truth, it looks like a report. It's got some pages, it's got some tables, it's got some visuals, and it's got some narrative. It probably isn't much sexier than that, unfortunately, but I'll try and walk through some of the sections that we're looking to potentially put in place in order to help you. So in terms of climate value at risk, that would provide an assessment of by property type, by flood exposure, across red and amber flood zones, both now and against the benchmark or control year. We'd also look at that data by various RCP scenarios across numerous timelines in order that you can view how that book would change based on the impacts of climate change. Of course, we wouldn't be who we are if we didn't provide you with a visual. Certainly, we would map that data. It definitely brings that data to life once you start to look at it from a visual perspective. But also, we'd probably want to look at the data from a regional basis, trying to understand where there are potential pockets of exposure that aren't necessarily obvious if viewed in aggregate. And we'd replicate all of that output based on who provides you with your capacity in order that you can then report that detail onto them if you so wish. From an emissions perspective, we'd report by grouped EPC ratings, again, both in terms of now and against a benchmark or control year for both residential and commercial properties. We're exploring the potential to report at sector level for commercial properties in order that you can identify the poorest performing sectors from an emissions perspective. Although, as we've heard, this is a particularly challenging area to address, and changes will happen over time. So that is something that we will certainly keep our fingers on the pulse with regards to. Again, we'd replicate that across capacity provider, so you can then report that back to those that provide support to you. So, what next? As we've heard, this isn't something that is going to go away anytime soon. In fact, over the coming months, there seems to be that there will be a clamour to a clamour for more visibility around what it is that climate change is going to do to your existing book of business. So what do you do next? Do you take control? Do you wait for clarity? Do you lead? Do you follow? Or do you simply take a first step? We're certainly here to help if your desire is to take that first step. But regardless of what you decide to do, we would definitely suggest that you remember that flexibility is key. We certainly believe that we can help you with that flexibility. So if you're open to having a conversation, open to talking to us about what it is you're looking to try and achieve, we'd be more than delighted to see whether we can assist in any way. Well, that concludes my part. Hopefully that was a whistle-stop tour through that template. I'm sure there are questions to come, but for now, back to Richard.
Thanks for that, Jason. There are a few questions, yes. So one of them is, what would you require from a client in order to produce that report, Jason? I'm assuming what type of data the client would need to supply.
Sorry, yes, I probably didn't actually mention that. Certainly, it would be a minimal amount of data that we'd require. Certainly an address of the insured properties, the premium value, the insured sum, and the type of property that it is, be that residential or commercial, if they happen to have that detail. Clearly, who provides capacity for that premium is also something that we'd require, but it definitely is driven by what the client would want to see from a reported perspective.
Okay. And actually, one for you, Mike. I suppose, how receptive do you think the market would be to this type of standardized solution that Jason was talking about there?
Yeah, so I suppose if I draw an analogy stroke parallel with the fair value, which I mentioned recently, and fundamentally when we spoke to the regulator asked us as an association and our sort of fellow associations, BEBA, LIBA, etc., as to why there wasn't more take up of standardization in terms of responding back on fair value. So clearly the regulator has in their view that standardization is better for them, it's better for the industry. So I would certainly, as a start point, encourage some standardization, because then that removes a lot of costs if you're doing it all in the same, as much as you can in the same way. And then picking up on Feargal's point, when the regulator particularly says, right, we want to see this data, then you can actually package it up and put it back to him from an industry perspective, as opposed to all different types of formats and all different types of data. So as a start point, Richard, I would certainly be one, and the association one, we would encourage standardization.
Okay, excellent. Thanks for that. One other question for you, Jason, I think. Is it only flood, or is there other data that you can produce the report for?
Well, I guess the answer to that is no, it's not just flood. Our initial focus has been on flood because it's probably the easiest or the most obvious peril, hazard, risk that people will want to look at. And certainly the data is widely available in that regard. But we've certainly got plans to look at subsidence, and wildfire. But that's very much driven by what the client wants at the end of the day, and we're quite happy to talk about how we can potentially deliver that.
Okay, excellent. Let me just have a quick check here. I think that is all our questions. We're a bit ahead of time, which is good, given everyone, they can have a bun now with their cup of tea before the next call. So look, thanks a million for joining us today. Any questions, you can link through the Gamma website, gammali.co.uk, and we'll see you on another GeoInsurance webinar in the future. Thanks. Bye-bye.
Thanks, Richard.
Thank you.
Thank you.